Great. So let's start with the first panel of the day, TradFi moving to DeFi. Every week, there are evident signs that traditional financial players are moving to DeFi. 2 weeks ago, for example, in France, Boursorama Bank, a traditional bank in France, announced that they will offer ETN, exchange tradable notes on crypto with CoinShares and Société Générale as partners. And if you look at just only BitL and their liquid fund, their growth has been quite amazing. They reached $1.7 billion in asset under management, and even Kaiko, right, was in this building now account for 250 million in AUM. So there's clear evidence that TradFi and blockchains are converging now, combining stability of TradFi and the innovation and efficiency of blockchains. So I'm very excited to have 4 experts on the topics today that have been talking to traditional financial institutions or even working for them. So maybe can you please introduce yourself as well as how your firm is actually enhancing this movement?
Yes, so I'm Ambre, I'm the CEO of Kaiko, and Kaiko is a market data and analytics company and blockchain, focusing on 2 things: crypto as an asset class, and working with financial institutions on market data and analytics. And we also work with the likes of asset managers that issue ETPs and ETFs, or derivatives trading venue that list futures, for example, on our data. We also are engaged on the tokenization initiatives with financial institutions, because a lot of bringing capital markets onto blockchain will involve market data and data-related considerations, and that's what we're focusing on.
Bernhard?
Hi, name is Bernhard Elsner. I'm the Chief Product Officer, Digital Asset. Digital Asset are the developers of the Canton blockchain protocol. The Canton network is a public layer 1 blockchain, viable both for traditional finance and crypto, right? We are strong believers that really the full universe of some 300 trillion outstanding assets, 2 quadrillion a year in payments, should and could move onto new rails to sort of give the same sort of interoperability experience and collaboration that we can already see play out in the crypto networks. And we've been working on this for years, proving out the viability for regulated enterprises. They're now pushing some $3.6 trillion in transactions through the network every month, really with an aim to break down that boundary between traditional finance and digital assets and crypto.
Daniel, yeah.
Great. Thank you very much. Thanks for having me. My name is Daniel Eidan. I'm an advisor and solution architect with the Bank for International Settlements. I'm part of their Innovation Hub. And the Innovation Hub is a little bit of a unique animal within the central banking space. So I'll just give a background. The BIS is kind of the central bank of the central banks, kind of colloquially known. And as ironic as it sounds, we have an innovation department. And the part of the innovation department, our mandate is to really look at cutting-edge technology, crypto, blockchain being one of those things, and really pull them into the context of central banks and policy and things like that. So I spend half my time in kind of the DeFi Web3 world. That's kind of where I come from. I'm an engineer and computer scientist by training, and I spend most of my day building out projects. I focus a lot on cross-border payments and kind of holding hands of our stakeholders, which are primarily central banks, on how these things work, where the value add is, and ultimately kind of bringing their innovation agenda to life. Because there's so many cameras pointed at me, I'll just mention that in order for me to speak freely, I only represent my own views and not necessarily the institution.
Not an investment advice, right?
Now we have the joke.
Hello, so I'm Sylvain, Chief Product Officer of Société Générale Forge. So I will be the French guy with the accent, the French accent for that. So we are focused on real-world asset on our side. We have 2 products, security token, and we have bond in token format, but also a structure product in token format. So it is the first use case, and we did a lot of experiment with not you as the central bank of central bank, but we did some experiment with Banque de France and the Booba also. So we know that it's a lot of work and a lot of protocol in this area. And the second one is we issued our stablecoin. So stablecoin that is pegged to euro. I think it was 2 years ago now. We spent a lot of time last year to onboard the crypto ecosystem. So for a bank, it's not so obvious to be honest. So we spend a lot of time to have distributor, market maker, exchanges. We spend a lot of money also. I was quite surprised. And now we hope to pouvoir distribute Euro CV through our partner and with the MiCA compliance. So we are focused on these two products for today.
Thanks for the insightful introduction. Sylvain, I want to start with you from an institutional perspective, because you've been fighting and battling the digital assets in Société Générale for years now. What are the primary concerns you have when adopting DeFi, and how can you tackle them?
Well, we want to integrate our stablecoin on DeFi. It is one of the main focus of this year. And to be honest, the security token is it's on hold for this year, because we want to provide this stablecoin to the ecosystem and to make it adopted by all players. So for the DeFi, we have a different process, as you may know. We have a lot of internal validation on Société Générale, because we outsource all the compliance stuff, the risk management stuff to Société Générale team. And it is something that is very new for them. So we need to assess all the, let's say, protocol and how we will mitigate risk on this topic. And so there is quite a long journey process. We start with a kind of due diligence on the protocol, and we target 2 protocols for our DeFi project. And after that, we go through internal validation in order to assess the risk appetite. So we need to educate also internally. And so the purpose is to have a limit in which kind, an amount of Euro CV we can deploy on the protocol. We need to ensure that the risk setup, because in Société Générale there is, I think you know better than me, but there is a reflex to apply a traditional risk process. So it means that we need to ensure that how you will structure the deployment in Euro CV in the protocol. In our case, we were forbidden, for example, to do it directly. So we go through a partner. And so the deal will be we will do unsecured loan of Euro CV to our partner. This unsecured loan need to be assessed in a competency and legal manner. With this incompetency and legal manner, we need to apply the CRR3, so the capital requirements regulation on top of that. And with that, we calculate capital to put in front of this activity. And Société Générale will charge us the cost of this capital, of course, because there is no free lunch. And so it is like this that Société Générale will accept us to deploy on the DeFi protocol. It is very early stage, so there is only two protocols today. And when they accepted it, we can deploy and we can do it in the DeFi ecosystem.
Just deep diving on that, historically you did the proof of concept on Maker, if I'm not mistaken, and so you mentioned a loan, so I'm guessing it's a lending borrowing protocol that you're looking at. Is it 2 lending borrowing protocols? Can you
by Maker, it was Maker was our first experiment, but it was more an experiment, to be honest, and it was on security token. And the difference is security token, you have some kind of control, so it was risky for Maker, but not for us, if I can say, because we borrow a DAI, and the collateral that we stuck in Maker protocol was not liquid, so they accepted to have a degraded liquidity process, and it was let's say an experiment. So it we can replicate it, but we need, I think the ecosystem now needs to have a better liquidation process. They need to have assets that are maybe on-chain for liquidation. So all this kind of stuff makes this use case more difficult to replicate. For stablecoins is another thing because the stablecoin is fully transferable. There is no KYC or control. There is a control, but a light one compared to security tokens. So we need to be more strict in terms of risk management.
Okay, thanks. I'll come back on these topics and these use cases. I think they're very interesting. Daniel, what's your perspective on BIS moving into DeFi, moving into digital assets in the first place?
Sure, maybe I can talk a little bit about the roles of central bank with DeFi. I think the exciting thing about the opportunity that we have is that central banks are really reevaluating what M0 money means and what functions it should provide to the ecosystem. So if you look at the history of innovation in financial services, it's kind of layers on top of layers on top of layers, and it's not every day that you kind of reevaluate the base layer. So a lot of people think about central banks innovating and maybe crowding out the market. I think I would flip the script on that and say that maybe that was the early experiments when a lot of the central bank work was really kind of preliminary. I think we've advanced since then to understand that M0 money needs to support a broader payment ecosystem and all the other layers of money that sit on top of it. And it's an exciting time for central banks to be in this space, reevaluating how M0 can sit and provide the kind of anchor of the monetary system that it needs to do. So central bank money plays a kind of special role in that context. It's the safest asset, and it should be used for specific environments. To answer your question kind of explicitly, what are the things that pull kind of DeFi into a more institutional world, specifically central banks that are inherently kind of risk averse and slow moving as a consequence? We have to see the use cases and we have to see the value. You mentioned kind of innovation and efficiency. It's interesting to note that anywhere that there's inefficiency, there are intermediaries extracting rents from those inefficiencies, and therefore a lot of the time when I look at kind of innovation agendas, they're just pushing around inefficiencies to different places, or maybe alternatively pushing around the rent-seeking component of that inefficiency to newer players, which is okay as long as that gets decreased, but I think it's something we need to keep a kind of keen eye on. When I look at the use cases that are really pulling DeFi tools into the traditional market, I'd say digital assets is of course a huge one. And that also plays an important role for central bank money because central bank money is used as the safest settlement asset for settlement of digital assets. Another one is cross-border payments. So you could argue that there's a potential kind of market failure in the cross-border payments landscape. It's a distributed system by design. Almost all payment systems are built for domestic contexts. And then when you zoom out, there really isn't a lot of infrastructure that's built for cross-border payments. And today we really live in a world that is fluent between different jurisdictions. And I think users and participants in the economy aren't expecting that kind of friction. And the last one is really kind of this notion around inclusion, and that really depends on which jurisdiction you're looking at. So there's inclusion at the level of the individual. I mean, here in France or in first world countries that most people have access to payment systems and the like. I mean, we mentioned stablecoins and things like that. Diversity in payments is good, but it's also a little bit risky if it gets fractured and too decoupled. But I would also encourage, or at least the things that central banks are thinking about, and international institutions like the BIS, also thinking a lot about inclusion of countries in kind of the front row seats in the world economy. And that's really important. There's a bank called CLS that does a lot of settlement against the dollar and provides reduces settlement risk when you're clearing large payments. And CLS, for example, only has 18 currencies. So what happens with all the other? And how can we think more holistically about bringing countries into that first row seat? People tend to talk a lot about capital markets because I think that that's where a lot of the action is, and that totally makes sense. But in the wholesale markets, a lot of it is about trade, actually. So if you look at the volume of transactions that go through capital markets, I mean, most capital market intensive areas have actually good access to financial infrastructure. It's on the trade side a lot of the times that you see high volume of trade without that front row access. So digital assets, diversity in payments, and kind of inclusion both at the individual level and at the jurisdiction level, I'd say are things that are use cases that are needing resolution. And then as we explore technologies, we try to make sure that that inefficiency actually gets reduced and doesn't get just kind of pushed around to different parts of the stack or different players.
And just on the inclusion part, does it mean representing on blockchains dozens of currencies, which they might are not being represented today?
Sorry, so your question is about issuing the currency directly on-chain?
Yes, that's right.
I mean,
in non-dollar or euro, essentially the few handful of currencies that are represented on blockchain today.
Yeah, I mean, right now there's no direct representation, at least on public chains, of these type of instruments. I mean, it's interesting to talk about institutions issuing stablecoins. Where does the line lie between stablecoins and tokenized deposits? There's all kinds of policy issues that I would kind of put out into the group to we can debate and discuss. Do these tokenized deposits or stablecoins, do they preserve the singleness of money so that when you consider a euro or a franc or a dollar, that there's singleness across the whole economy and people aren't trading these at different values depending on if you're a Credit Suisse customer or a UBS customer, for example. There's issues with elasticity on stablecoins. That's also something that central banks care about a lot. And then you also mentioned kind of KYC, AML, kind of a little bit tongue-in-cheek, but that's also something that we're concerned about as well. So when you think about M0 represented on-chain at that level, there's a few kind of hurdles and policy choices that I think a lot of the central banks need to be comfortable with in order to do that type of issuance. That's at the M0 central bank money level. Outside of that, when we think about tokenized deposits or other instruments that can bring kind of the value of central bank money in a specific context, whether it's retail or wholesale, I think that's maybe the first thing that will happen, and then maybe central banks will get engaged more directly.
That's super interesting. Bernhard, from your perspective, and you built Canton to overcome the obstacles of institutions and potentially central banks moving on chain. Can you explain, from your perspective, what are these obstacles and how Canton helps tackling them?
Yeah, for sure. I mean, what we're ultimately trying to do is really create a venue where interoperability and collaboration can happen with the fidelity sort of we now see on the public chains within DeFi, both between institutions as well as between institutions and crypto and DeFi. And the way I think about that sort of interoperability it always happens within a sort of venue, right? And that venue can be a message-based system like Swift, it can be settlement systems like T2S, it can be blockchain platforms like Ethereum and Solana. And we see really different levels of what sort of collaboration and interoperability they enable. And today we're still in a world where we've got these really hard dichotomies, right? We talk about digital assets and traditional assets and DeFi and TradFi and RWAs and crypto because we effectively only have two sorts of venues, right? We have the crypto suitable venues, the public permissionless transparent networks, where we have an incredible wealth of sort of innovation and collaboration going on, people innovating with new forms of business, new forms of assets and so on, but that are simply not suitable for most everyday finance in the capital markets. And we have the traditional systems, which are highly trusted and work, but are slow and inefficient. And ultimately, that also leads to these breaks where, because collaboration in a way is a least common denominator affair, where we have this impedance mismatch, when it comes to the interplay between the old and the new, like stable on and off ramps, to talk about the sort of the singleness of money there, or collateral within crypto trading, or just generally how people have to get in and out of crypto through highly centralized means. That we need to overcome. So what we've been focused on for a long time is to think about what does it take to create a venue that offers the interoperability, that fosters the collaboration within the DeFi networks, but is actually viable for traditional finance all the way up to central banks, CSDs, that could bring the existing 300 billion in assets natively, actually bring cash on ledger, actually bring sovereign debt on ledger. And I think it comes down fundamentally to three factors that we need to solve with blockchains. The first being, and there's a lot of nuance to this, permissioning, right? Often when I say permissioning, people think, oh, it's going to be private permission stuff. And I think this is something that sort of we've baked into our language, that we sort of have this dichotomy between public permissionless and private permissioned, which we need to get past. My analogy there is always the internet, right? The internet is probably the most public network we all know. Anyone can connect to it, participate in it, launch applications, even run infrastructure. But within the internet, applications and the finance you run through it are highly controlled and permissioned, right? You can go to the front page of a bank. You can't just, go and look at all the accounts and manipulate them. And traditional financial assets, they run through trusted entities like central banks, like CSDs, and so on. They need the ability to permission these assets and services to the degree they simply have to. And a special kind of, I would say, that permissioning is privacy. And we all know about blockchain privacy. It's a long-standing topic. And that's something that we've been focused on for day one. I would say that was one of the first topics people understood were absolutely needed. And one of the things I love to do at events like this, at conferences, is always ask people, we're all working in digital assets to some level. So we should really be using this stuff ourselves. Right? So if you could have a payments card today, like a debit or credit card, which just wrote all your day-to-day transactions transparently on a blockchain, would you use it as your primary payments card? Would you be willing to draw your salary in stablecoins on a transparent blockchain? For those in management, would you be willing to consider paying your employees? There are some people that are, yes, some do, absolutely. The general sort of mix of people is the response is relatively muted. Most people do value their privacy. And I think in institutional, that goes much deeper, right? Organizations do not lay open their day-to-day trading, their portfolios, their transactions. They report in a very controlled way what they do once a quarter. So until we can offer them the same means of controlling their business secrets, they will not move onto new rails. And the third, and I think for the really large institutional that may be the most important, is self-sovereignty, right? Ultimately, we all want, real cash, actual sort of fiat RWAs like sovereign debt to move on chain. But if you think about what that means, it means the national central banks, the CSDs sharing a venue. And they cannot give up essentially their national mandate, their control in doing so. So one of the things that we've done very carefully is to design a system around the idea of having a network of networks where those sorts of organizations can retain sort of self-sovereign governance in their corner, in their sort of national realm, while still maintaining that smart contract interoperability that drives collaboration within DeFi across these networks. Right? And I think with those three properties, we've been proving this out over years now with institutional players. You can actually get assets as they exist today, native bonds, native cash, onto new rails, onto blockchain, and mix them there with the new forms of assets and new forms of business like crypto and DeFi. And I think that will unlock completely new possibilities in that interplay between the two worlds, which right now is quite clunky.
Right, and to my understanding, as far as I remember, you started with private permission blockchains and to slightly evolve into public permission, or the combination of both, which makes the Canton solution so unique.
Yeah, I think we've approached the problem in the reverse to a lot of other networks, right? The company started always with a vision to bring capital markets and finance onto new rails wholesale, right? The whole spectrum of 300 trillion assets and 2 quadrillion in payments. The sort of the difference in approaches that most networks solve I would say, the connectivity and open network problem first, and is now trying to figure out how to add controls and privacy to make these venues viable for regulated enterprise, which I personally think is a really hard path to take. We are looking, of course, with great interest at all the amazing research that's going on, with zero knowledge proofs and homomorphic encryption. Find me later during the drinks. I'm happy to have conversations about that. It's a long road, and I think we're years away from getting those to a level where a central bank should be comfortable with them. A really long way away. So we've taken the opposite approach. We've thought about, okay, how do we build a DLT rail that has the properties that we need built in, prove that out with financial institutions in relatively safe spaces, and then drive the network effects by connecting them to each other. Right? And again, there we've taken a slightly different path to others. For a long time, there was this, I would say, this story out in the market that all the financial institutions would build these one ledger per bank, private permission networks, and then they would just sort of have magic bridges that would make it all interoperable. I don't believe in that story at all. I don't think bridging has anything to do with the sort of interoperability that you get within a layer 1 blockchain. So we've always designed with the idea of building a single layer 1 network that has these properties in the end.
Right. And it's a long journey, and thanks for not giving it up. Amber, from your perspective and Kaiko's perspective, you started with off-chain crypto data and on-chain crypto data. And you've been trying to educate financial institutions as they would need data first to understand this ecosystem. So have you seen an evolution in terms of needs and in terms of demands?
Absolutely. So the vision behind Kaiko was to say there's going to be a few years. I didn't think it would be 10 years. I thought maybe 3 to 5 years. But a first phase where financial institutions are going to look at crypto initially as an investable asset class. And for any investable asset classes at an institutional level, you require some sophistication in your market data pipelines and in the quality of the infrastructure that delivers you financial data on any investable asset class, right? And crypto is one of them. Now that was step one, and I think we're way beyond that now. Everybody knows and everybody touches crypto in some form or shape. But then the second step was to say once hundreds of millions, billions of dollars of investments will be deployed in the asset class, institutions will take a deeper look at the underlying technology and specifically the transformative power of that technology when it comes to operational efficiencies for themselves. And that's why the focus for Kaiko, even within the market data business, was always to focus on financial institutions, because for us, they were the obvious candidate to move into the bigger vision and the trillion-dollar play, which is asset tokenization. And asset tokenization, I remember a couple of years ago when we were talking about fractional ownership of art, and I thought I would die, because I was like, that is not the point. I don't need a quarter of a centimeter of a famous painting. The point of tokenization is not about fragmented liquidity, in my opinion. It's about operational efficiency. It's about really disrupting the current value chain of front to middle to back office and settlement layers and payment layers and all of the kind of delivery versus payment part of capital markets. It's about OPEX efficiencies. And blockchain for that is a pretty fascinating technology. Once we start tokenizing assets on chain and those assets live on a network where they can be transferred more easily, where they can be exchanged more easily or used as collateral to enable other financial applications, this is where you actually start having some real operational efficiencies. And the idea with Kaiko was to say, first, we're going to work with all those institutions in providing them financial data on the asset class. But all of the technology and the rails and the infrastructure that we build as a data provider is exactly the same whether the actual token price we provide is an ERC20 token or if it's a tokenized money market fund, right? From a technology standpoint, what we do today is that we read data from APIs, for example, the Coinbase API. We read data and we operate nodes and we read data.
Or the blockchain.com API.
Or the blockchain.com API,
Nicholas.
Sorry.
Yep.
Yes. So we read data directly from centralized exchange APIs. We run our own node infra and we get all of the block data and reverse engineering that to be able to extract the financial market data generated on chain, whether it's from DEXs or lending and borrowing protocols. we have the whole data processing pipeline, and then the distribution pipeline where we redeliver any kind of market data either through APIs or Snowflake or whatever kind of data distribution mechanism, but also back to chains. So we work with oracles, obviously, but we also have our own on-chain delivery systems where we can deliver data back on-chain to enable the execution of smart contracts. Everything that I've just described here, we basically do the data layers of interoperability between traditional financial market data systems and blockchain systems. And that scales then onto capital markets use cases where we know the importance of data in a TradFi world, where if you think about a blockchain-enabled capital markets industry, where things are much more disintermediated and automated, the data component, the data input that you're going to feed into the smart contract to enable a financial application on chain becomes increasingly critical. The role of a data provider becomes even more important in an on-chain world because you're not going to have middle office and back office and all these intermediaries that are going to prevent some trade or settlement from happening. So data becomes more critical, that's number one, in an on-chain world. In the world of tokenized assets, the actual financial data of the tokenized asset does not natively live on-chain. And that is also something really interesting, which calls even more for the existence of a data application layer that will securely bridge the world where the data lives initially. If we think about private credit, it's going to be at the issuer level, and the financial application on-chain that needs to have that financial information to execute. And we've been working a lot with Canton lately, specifically because of those privacy features that makes us as a data provider able to enable a financial application on-chain without having to reveal the actual financial application to the entire network.
So that's interesting. How do you do that?
That's literally how Canton was designed, right?
Yes, I mean, so I get definitely the part where Kaiko, as a tokenized money market fund, half or maybe 80% of the architecture is a fund in architecture off-chain, and then there's a token that is being distributed on blockchain to enhance billions or millions of users to use it in the future. How can a data provider work with Canton as it's privacy at first? How can you bring transparency and data availability on a private network? I guess that's my question.
So it depends what you call transparency, right? And what level of transparency you need. If you need to use, you need a calculation agent to just price things and publish those prices on chain. So that is one example. We're working on a couple applications now where one is just getting financial data on the actual activity and bringing it off chain. One of them is there are trading activities happening on chain where you need independent calculation agent prices, where we would just price options and then publish those prices on chain. And then there's a third thing that I like and that is also elegantly doable on Canton, which is the sub-licensing part. So if we think about the world of private credit, where an issuer is going to issue private credit and wants to tokenize this on Canton, the coupon amounts, right, the yield of that note does not live natively on chain. If you want to price that note, you need somebody to take the data from the issuer, and that's often non-public data that you can use to price an instrument and provide that price on chain for NAV calculations or for any kind of settlement calculation. So it's really about bringing prices and marks on chain in a way where you don't have to reveal all of the data sources and inputs.
That's super interesting. And Sylvain, from your perspective, does the underlying layer matters? And how do you choose the network you decide to play on DeFi with?
So privacy could be a concern in the future. We discussed with Canton on some use case for security token, and we value the privacy. But I think we are on the first stage of real-world asset adoption. We are still at the first stage, unfortunately, because we said the same thing 5 years ago. So maybe it will be the end of the first stage. But what I see, because this main first stage was clearly focused on stablecoin, we see a lot of an increase of market cap of stablecoin. And what we today, We value the transparency nature of the blockchain, and when we speak with our compliance risk manager, it was clearly a feature that make it possible for us to deploy the stablecoin. And when we combine the transparency nature of the blockchain with a monitoring tool like Chainalysis, our compliance are happy, and if our compliance are happy, we are happy. So it was clearly helpful for that. And yes, Ethereum has a lot of TVL. There are a lot of things to do on Ethereum, so we go through Ethereum. We will deploy on Solana because there is a lot of use case also on Solana. So we go where we think there is value, but today the privacy is not required from our perspective. But maybe on the secret chain it will be the case, and that's why we discuss.
Stablecoins, yeah.
For stablecoin, for secret chain, the
security
could be
tokens,
completely different.
Yeah, I mean, so sorry, I'm right. I want to be very clear. There's a lot of really interesting activity in the transparent network. So there's clearly a whole spectrum of finance that can be done without privacy. But you have to take sort of the relative sizes into account, right? We currently have that space of, what is it today? I don't know, $2 to $2.5 trillion worth of assets that can support that radical transparency, and stablecoins are clearly one of those. And then in comparison, you have a universe over 100 times that large of other assets that do not support that radical transparency, right? And the big unlock for all of us is to get those other assets onto compatible rails, right? To break down that barrier between the two worlds. And I think privacy is an absolute must for that, right? As long as sort of people have to choose one set of rails because we need some privacy, or crypto rails because we can manage with full transparency, it's going to stay an island.
But maybe, yeah, I'm agree with you on this point, because one thing to push DeFi further is to have a lot of security token sourcing, so funds, bonds, equity to play with. So if we want to push DeFi at the maximum level possible, we need to find a way to onboard institutional on this security token specific area. And I think the privacy will be an important feature. But today it's limited by that.
Yeah, because today it seems you're chasing for the on-chain users through your stablecoin, and that's where the TVL is. But as, for example, private credits are moving on chains with all these institutions being confident, moving this information on chain, then privacy will be needed. Daniel, from your perspective and potentially the BIS, I don't know if.
Yeah, I mean, I can give a couple of reflections just on the conversation. A lot of good things are being said. I think it's just interesting. I guess we're slowly running out of time. Carlos is waving frantically in the background.
You still have time, no worries.
I'll speak really quick.
And Carlos is a friend of yours, so I don't think that's super friendly to cut your friend. So there's a lot of contradictions, in the desirable features. We talk about privacy and we talk about transparency. Where do we set the bar? This isn't really a technology question; it's a policy question. And then through the policy, we can implement it through the technology. To your point, Bernhard, I mean, people take different approaches when they build these systems, but ultimately these are trade-offs, and they should be recognized as such. We think about kind of trustless protocols, but then how much do we understand the protocols? I was in a discussion earlier this morning talking about blockchain smart contract auditing and how few people there are in the world almost that can do that kind of work, and how critical it is to a lot of this infrastructure. The discussion around inefficiencies I think is really interesting. That's something that, of course, no one wants to see these inefficiencies, but when we reduce some of the inefficiencies, a lot of them get trapped at an institutional level and don't actually make it to the end clients or don't give business advantages. And I would argue that it doesn't matter how much inefficiency you remove, if it doesn't actually change the market dynamics to create new equilibrium between the participants, it just doesn't matter. You're just making profitable institutions more profitable at the end. So you really need to find the inefficiencies that can make it all the way down to the end consumer. And at least in my world, we often find the best use cases are use cases that have the least amount of risk. And I'll give a good example of a tokenized asset project that we built out.
And the notion here was how governments fund international development institutions, specifically the World Bank and the IMF. And one of the ways they do it is through these things called promissory notes. These aren't private promissory notes that you think about from kind of traditional capital markets. These are ministries of finance saying, we will fund the World Bank, $100 million over the course of the next 10 years for this purpose. I happened to kind of chance upon a meeting that there was a reconciliation session between some of these central banks and some of these institutions, and there were errors on the pieces of paper that track these payments. And my jaw dropped to the floor and said, hey, this is a great opportunity for tokenization. So we built a prototype where we tokenized these promissory notes. I'll give a free plug. We actually built it on Canton, preserved the privacy of all the institutions, gave them kind of sovereignty and autonomy of their own sub-networks, and everyone loved it. So that was a great use case where it was like, why are we doing it like this? Hold on, no one really knew. Oh, we take the piece of paper out of the safe, we drive it across to the other central bank, we sign it here, we sign it there. And it's all for historical reasons. There was really no downside to the efficiency gain. And we built it out, showed everybody that it was possible. And now it's something that kind of has legs in the market, and we may hear more about that. And there's a white paper actually coming out at the end of, in a couple of months. So, picking the use cases very carefully and seeing how you can kind of move things forward and being considerate of what to move forward, I think, at least in my world, is kind of the name of the game.
That's an exciting use case, and I didn't know you were already building on Canton. So as we say in the beginning, not a financial advice, right?
No, definitely not. Definitely not.
And maybe, and Carlos, yes, we ran out of time, so quick, short, exciting closing remarks. What are you excited about these days in crypto, in DeFi? What makes you optimistic?
Very happy about all the tokenization initiatives. So not because it was the conversation, that's really, I think 2025 is the beginning of the next decade. I agree. I had it 5 or 6 years ago in my seed decks, trillions of dollars of tokenized assets in 2 years. Didn't happen, but I feel that it's now the beginning of the inflection point where we are going to see real life size on tokenized assets.
10 years after, we're getting there.
Yeah, we're getting there, exactly.
Bernhard?
Yeah, I think there is a real new momentum in getting traditional financial assets on chain. What I'm really excited about at the moment is the whole space of collateral mobility that's playing out, which is a huge pain point for both traditional finance and crypto. Really requires privacy. And I think if we get that rolling on chain, that could easily tenfold the volumes we see on blockchain networks today, just with a single use case. Super exciting.
Can I add something?
Yeah, of course.
So,
of course.
Actually, the current environment is crap, right? Everybody knows that the markets right now, globally, not just crypto, is pretty bad. But I want to say something. As much as it's painful for everybody who holds crypto, I think that from a tokenization and changing at an infrastructure level, operational workflows and TradFi, it can only happen in times like this. And it's an opportunity because now everybody's trying to cut costs. And this is a cost-saving thing. And when everything is good, you don't touch something that works, right? So I feel that the fact that it's such a mess right now is an opportunity for the capital markets side of blockchain.
As well as when the default yields are actually real-world assets type of yields versus DeFi yields going down. Daniel, exciting thoughts.
What am I excited about? The BIS Innovation Hub is working on something called the Unified Ledger, and I think that's something that's super exciting. And the idea there is to really understand where the value is of distributing protocols versus centralized. It's not just everything should be distributed, but it's looking very carefully at the technology stack and trying to create some type of unification that we can have public M0 money on top of private money. We're running a huge project with 5 of the international currencies with 2 extras, so the big currencies are at the table. It's a public-private partnership, so it's not the central banks are here to kind of do it all. It's the central banks are providing the base layer. On top of that, we have 43 private institutions that are participating with us in 7 different countries, and we're really honing in on designing a financial market infrastructure that can facilitate cross-border payments across the world. And if this works, I think it's a truly kind of exciting moment. I think we always kind of overestimate in the short run and underestimate in the long run. So I think what I'm most excited about is to be here in the long run and see how much we underestimated what we were doing today.
Be here in the long run. Let's not give it up now, right? It's like after all these years, Sylvain.
I'm pretty, I quite agree with you. So I'm pretty convinced that blockchain is clearly a breakthrough technology. And I'm pretty sure that we will see a lot of security token on Ethereum or other blockchain. I would like to see more and more native security token, and because I saw a lot of different, let's say, not experiment, but for example, unified ledger, all this kind of stuff that the central bank want to promote in order to have their own infrastructures and own layer one. But I'm pretty sure they can do it on Ethereum and not to use another kind of technology, because we have too much layer one, too much things. So we don't want to have a silo technology with a lot of exchange, with a lot of fractionalized liquidity. And so I would like to see like BlackRock to have they go to Ethereum, they will try Ethereum, it's not fit their model, they will maybe use another one, but we need to push the technology at the best possible way. I would like to see a lot of security token on Ethereum and a lot of stablecoin, a lot of volume, and it would be really nice.
Maybe the BIS one day.
Maybe.
Tokenizing on Ethereum. So thank you very much all. That was our first panel. Please.